Swayam Prabha. Digital India. Educated India.
Good evening, dear students. Today in this particular video, in this particular lecture, we will be discussing the basic principles of insurance. And in addition to that, we will also be discussing the concept of reinsurance. So let us start. As you know that insurance is basically a cooperative device to share the risk, and it is not there in order to make some profit, and it is very useful for the development of the economy. And in case our insurance sector is well developed, it is, you may say, it is doing very well, so it will be a boon for the economic development of a country. It will be providing employment opportunities, and it will be there to help the business, so that business is able to take the risk and no fear of risk is there. And ultimately, when business will be concentrating, when companies will be concentrating on their core strength, and the as far as risk is concerned, it will be taken care of by the insurance companies, and they will be giving an insurance cover to the companies for some premium. In that case, companies will be able to concentrate more on their core areas, and it will increase their productivity. So it should be kept in mind, and it is very useful for an economy. And my dear students, as far as history of insurance in India is concerned, kindly note that it is not a new concept as far as India is concerned. It is very old, and you will find indirect mention, not directly but indirect mention regarding pooling of resources. It may be such mention may be found even in great writings like Manu Smriti, like Arth Shastra by Kautilya. You will find this. And in India, basically the insurance business started in it basically in the modern form, you may say. It originated in 1880. Basically it was started by the Britishers for their own benefit, because some trade was there. So in order to help in trade, introduced insurance in the modern form in India in 1818. And it was originated first of all with the establishment of the Oriental Life Insurance Company in Kolkata. And basically life insurance and non-life insurance, two type of categories are there. And then in 1829, the Madras Equitable had begun transacting the life insurance business in the Madras Presidency. Then in 1870, the enactment was there, that was the British Insurance Act. And in the last 3 decades of the 19th century, then the Bombay Mutual, Oriental, and Empire of India, they were started in Bombay Residency. Then various things happened. Then you may say the government of India started publishing the returns of insurance companies in India, and and Indian Life Assurance Companies Act 1912. It was the first statutory enactment. It was the first statutory measure to control life insurance business in India. In 1928, the Indian Insurance Companies Act was enacted in order to enable the government to collect statistical information about the insurance business. And my dear students, kindly note that it was applicable for all the types of insurance. It had covered life insurance, and it had covered non-life insurance business also. And then after some time in 1938, the existing legislation was consolidated, and it was amended by the Insurance Act 1938. And the main focus was that it was having comprehensive provisions for the effective control of activities of insurers. You have already studied while discussing banking, that government had nationalized the banking sector. Similarly, in order to curb, in order to control, in order to deal with the allegations of unfair trade practices, the government of India decided to nationalize the insurance business. And dear students, please keep in mind that the LIC, Life Insurance Corporation, that is there today also, and that is coming up with its IPO very soon. It was established in 1956, and basically it had absorbed 154 Indian and 16 non-Indian companies. So basically insurers and 75 provident societies. So it should be kept in mind. And as a result of liberalization, as a result of LPG, you may say, liberalization, privatization, and globalization, insurance sector was reopened to the private sector during late 19s, and nowadays we are having IRDA, that is basically regulating the insurance business in India, be it life insurance, be it non-life insurance, and whether it is conducted by, you may say, government companies, public companies, or private companies, all are being regulated by the IRDA. And as far as the general insurance is concerned, dear students, kindly note that it has its root in the establishment of Triton Insurance Company in the year 1850, then Indian Mercantile Insurance Company. It was the first company that was transacting every type of general insurance business. Then in 1957, the General Insurance Council was created, and it basically formulated a code of conduct for ensuring fair conduct and sound business practices. And then afterwards, what was there? In 1972, a General Insurance Business Nationalization Act 1972 was there, and it took over the shares of 10 Indian and 52 other insurers who were carrying on the general insurance business. And then four companies: National Insurance Company Limited, New India Assurance Company Limited, the Oriental Insurance Company Limited, and United India Insurance Company Limited were created. And in 1971, GIC, that is General Insurance Corporation, was incorporated, which commenced its business from 1st of January 1973. Then in 1993, the government set up a committee under the chairmanship of Shri Aryan Malhotra to propose recommendations for reforms in the insurance sector. And on the recommendations of this committee, this Aryan Malhotra committee, private sector was allowed, and as it was recommended by the committee that private sector should be allowed, and foreign companies should also be allowed to enter by floating Indian companies, preferably a joint venture with the Indian partners. And accordingly it was done as it was recommended by the famous Aryan Malhotra committee. IRDA act was there. From 2000 it started working, and various changes were made in GIC and Subsidiary Act. In November 2000, GIC was re-notified, and it was re-notified as the Indian reinsurer. So it should be kept in mind. And earlier, four subsidiaries were under its control, but then in November 2000, its control that was there on over four subsidiaries, it was entered. And then afterwards a GI, General Insurance Business Nationalization Amendment Act 2002 was passed, and it came into force from March 21st, 2003. So GIC ceased to be the holding company of its subsidiaries. So it should be kept in mind, and the ownership of all of these was vested with the government of India. And as far as the present status of insurance industry in India is concerned, so dear student, kindly note that nowadays we are having 58 insurance companies, including 34 general insurance companies, including the ECGC and Agriculture Insurance Corporation of India, and 24 life insurance companies in India are also there. And during the recent past, very impressive growth rate has been observed as far as the insurance industry in India is concerned. And Indian insurance is very, you may say, it is playing a prominent role in global scenario also. Indian life insurance business, it is ranked 10th in the world, and India's share in global life insurance was 2.73 during 2019, and during the fiscal year 2019-20, life insurance industry in India, it basically had an impressive premium collection. Its premium income was rupees 5,72,910 crores. Similarly, in non-life insurance business, India is ranked 15th in the world, and India's share in the global non-life insurance market was 0.79 during 2019, and the premium collection as far as non-life insurer business is concerned, and the gross direct premium collection as far as non-life insurance business is concerned, it was 1,88,916 crores. And one thing more, at international level, LIC business, the share of LIC business in total premium was 46.34%, and the share of non-life insurance premium was 53.66% during 2019. And one thing more I would like to mention, I have collected this data. So it should be noted that the share of life insurance business for India was high at 74.94, and the share of non-life insurance was stood at 25.06%. Now, my dear students, we will be discussing what are the principles of insurance. Basically, seven principles are there. Principle of insurable interest is there. Principle of utmost good faith, indemnity, causa proxima, contribution, mitigation of loss, and subrogation. These are the basic principles. Now let us discuss these one by one. So first of all, dear students, kindly note that insurance contract is a contract of sharing of risk. And in order to do insurance, in order to get the benefit of insurance, it is a necessity, it is required that you must be having insurable interest in the property, in that thing, in some you may say, in some person, we may also say that in case that thing is there, that person, he or she is there, it is in your favor, it will benefit you, and not otherwise. So in order to have insurance, insurable interest should be there. In case you are not having insurable interest in a person, in a thing, in some building, in some something, maybe, then you will not be able to get the insurance policy from the company. So the principle of insurable interest is applicable to each and every contract of insurance. So it should be kept in mind. And when the insurable interest should be present, in case of life insurance, it should be present at the time of inception of the insurance. That means in the beginning. In case of marine insurance, it should be present at the time of loss, or at the time when claim is made. In case of property and other insurance, it should be present at the time of the inception as well as at the time of the loss. So it should be kept in mind. Now, second principle is principle of utmost good faith. My dear student, kindly note that this Latin phrase is there, overima fides. It means utmost good faith. That in case of insurance, as it is based upon mutual trust, so it is the duty of the seller to give each and every information, to clarify each and everything, to give detailed information regarding the policy. And it is the duty of the buyer, it is the duty of the insured also, to tell each and everything in detail to the insurance company. So the principle of caveat emptor, that let the buyer beware, it is not applicable in case of insurance contract, as in this case it is the duty of the insurance company also to describe in detail the various fundamentals, the various points relating to the policy. And it is the duty of the person taking the insurance policy to give the detailed information regarding himself, regarding the property, in case the type of, it will depend upon the type of policy that is being taken, that is being purchased. So it should be voluntary. All the material fact that may affect the premium, that may affect the decision to give or not the insurance policy. So these should be described in detail. And absolute good faith, utmost good faith, proper full trust should be there. So it is the duty of the company that all the terms and conditions, all the fundamentals, all the you may say minute things relating to policy should be disclosed to the person getting the policy. That means to the insured, to the policyholder, and it is the duty of the policyholder. Now, till he's buying the policy, but till then, so he's a simple person. He has not yet bought the policy. So it is the duty of the person to reveal each and everything. In case of health insurance, in case some disease is there, it should be brought into the notice of the company. In case of life insurance, it should be brought into the notice of the company. So nothing should be you may say missed, and no false information should be given. Now, my dear students, third principle, it is the principle of indemnity. I have already told you that principle of insurance are there, and these should be followed. And insurance should not be used as a tool to earn something. It is not so. It is basically a device for, it is basically a cooperative device for sharing of risk. And now, what is indemnity? It is basically financial compensation that is given and that is sufficient to place the insured in the same financial position after a loss as he enjoyed immediately before the loss occurred. So that is, we are compensating him. We are making him or her comfortable, and we are bringing him back to the position which he enjoyed earlier before the loss was there. So that is the principle of indemnity. And again, I am telling that that the insured, that the policyholder is not allowed to make profit. Insurance is not for profit making. So he or she should not try to get some profit out of the loss suffered by the policyholder, or policyholder should not do such things. The compensation should be equal to the or less than the actual loss. In any case, it can't be more than the, it can't exceed the actual loss in any case. And but one thing more, it is not applicable. The principle of indemnity is not applicable in case of life insurance, and it is not applicable in case of disablement. As we will be giving the money, we can't replace, we can't give the person who has lost his life. So it is not possible. Now, principle of causa proxima. My dear student, it is known as the nearest cause, the proximate cause. That means the immediate cause, not the remote cause. So, immediate cause of the loss should be taken into account. So, in case you have insured something, you have insured any article, you may say in case of marine, you have taken a policy for a particular risk. Then at that point of time, it will be seen that what is the nearest cause for the loss, and it should be checked, it should be verified whether you had taken policy for that. In case it was covered in your policy, only in that case the loss will be compensated, not otherwise. Now, principle of the contribution. What is principle of contribution? It basically ensures equitable distribution of losses between different insurers. In case number of insurers are there, then then right of insurer who have paid a loss to recover a proportionate amount from other insurers. So it is the principle of contribution that all of them should be contributing, and in case it is the policyholder is compensated by the by any one insurer, then even then that particular insurer is entitled to recover a proportionate amount from other insurers who were also liable for the same loss. So it should be kept in mind. Again, it is not applicable to the life insurance. My dear students, kindly note that in case the following conditions are met, only in that case this principle will be applicable. First is two or more policies are there. Then policies must cover a common interest and a common peril, a common risk, a common, you may say, hazard, which is the root cause of the loss that is being covered by the policies, and subject matter is common. And at the time of the loss, all the policies must be in operation. So it should be kept in mind. Now, principle of mitigation of loss. It is very significant principle. It basically signifies that we should be trying, as I have told a number of times, that insurance is not for profit. Insurance is a cooperative device to share the risk. So in that case, in case you have taken the insurance policy from some insurance company, then you are under responsibility. Now it is not so that once you have taken the policy, now you are not taking care of the asset that has been insured. It is not so that now you are sure that it will be given by the insurance company. Even then, you are supposed to make sincere efforts in order to safeguard the property. In order, you should make efforts in order to reduce the loss, in order to save the property. In case it is proved that you are not making reasonable efforts to save the property from the loss, the insurer may not pay you. So it should be kept in mind. In case it is found that you are acting in a negligent way in order to save the property, once you have taken the insurance policy, so in that case, the insurer may be relieved from his liability. He may not pay you the amount. Now, principle of subrogation. Subrogation means that the transfer of legal rights of the policyholder of the insurance policy holder to the insurance company to recover something in case once the party once the policyholder has been compensated. So when the insurance company has compensated the policyholder, in that case, after that, the company will step into the shoes of the policyholder insured to claim the damages caused to the property by some third party. So it should be due to whose negligence or due to whom the damage is there. And it is applicable only in case the damaged property has some value after the event causing the damage is there. Again, my dear students, kindly note that principle of subrogation is not applicable to life insurance and personal accidents. Now, reinsurance. Dear students, kindly note that when the amount of the policy is very large, it is basically a method whereby the original insurer transfer all or part of the risk which he has assumed to another company with the object of reducing his own commitment to an amount that he can bear for his or her own account commensurate with his financial resources in the event of loss. And as I have already told you in the beginning, that in India, GIC, that is General Insurance Corporation, is the sole reinsurer in India. So no other reinsurer in India. And GIC Re, it receives statutory cessation of 5% on each and every policy subject to certain limits, and it is the only reinsurance that is there in India. And it has been ranked very recently, it has been ranked 13th largest reinsurer groups in the world. So, dear students, that was all from my side. As far as brief history of insurance is concerned, and as far as the basic principles of insurance, including reinsurance, are concerned. Okay, then, thank you.